Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of business. Today we're diving into a filing that smells of a corporate wedding. A big bank is buying a credit card company and the shareholders just had to say, I do. Let's see what they voted on and what it means. This Form 8K is basically a quick update to tell everyone that something important happened. In this case, it's about a special meeting held on February 18th, 2025 by Discover Financial Services. They needed their stockholders, which are the people who own the company's stock, to vote on a big decision whether to approve a merger, which is like a marriage, with Capital One Financial Corporation. So, Discover Financial Services is the company being bought. They had a meeting where people holding shares got to vote on whether or not they agreed with being bought by Capital One. Think of it like a popularity contest where the cool kids, in this case the big bosses and the shareholders, decide the fate of the company. This number is like Discover's social security number for the stock market. It's how the government keeps track of all their filings and paperwork. This is just saying that Discover is legally based in Delaware. It's a popular state for companies to set up shop because of its business-friendly laws. Think of this as Discover's tax ID number. It's what they use when dealing with the IRS, the government's tax agency. This is Discover's main office address where the big decisions are made. This is just their phone number in case you want to give them a ring. This tells us that Discover has common stock, which is the kind most people buy and sell. Each share of this stock gets one vote at shareholder meetings. DFS is the ticker symbol, which is a short code used to identify Discover's stock on the New York Stock Exchange. It's like a nickname for the company on the stock market. The New York Stock Exchange is where you can buy and sell shares of Discover. It's like a giant auction house for company stocks. This is just a standard question for smaller companies that are just starting out. It doesn't apply to Discover, which is a big established company. This is another question that doesn't apply to Discover. It's about whether a smaller company wants to take extra time to follow new accounting rules. So the main event was the vote on whether or not to approve the deal with Capital One. They also voted on some related things like how the executives would be compensated if the merger happened. All of these details were explained in a document called the Joint Proxy Statement/Prospectus, which was available for everyone to read beforehand. This tells us that on December 27th, 2024, they counted up all the shares of Discover stock to see who was eligible to vote. There were about 251 million shares out there, and each one got a single vote. At the meeting, enough shares were represented either in person or by proxy to make the vote official. They had 82.19% of all votes available. This is called a quorum. Here's the juicy part, the actual vote results. The first vote was on whether to approve the merger with Capital One to adopt the merger agreement. Over 205 million shares voted in favor, while only a little over 1 million voted against it. There were also some abstentions, which means people chose not to vote either way. The merger was approved. The second vote was on the compensation proposal. This was an advisory vote, meaning it wasn't binding, but it was about approving the payments that the top executives at Discover would get if the merger went through. Think of it as a bonus for the bosses for making the deal happen. Again, the majority voted in favor, although there were more votes against this proposal than the merger itself. 194 million votes in favor, 11.9 million against. The third vote was on whether to adjourn or put off the meeting if they didn't have enough votes to approve the merger. This was basically a backup plan in case they needed more time to convince shareholders to vote. Yes, but since the merger was approved, they didn't need to delay the meeting. This proposal still needed to be voted on, so it was approved with 195 million votes for and 10.7 million against. Because everything was approved, they didn't have to stop the meeting or continue it. Regulation FD disclosure is basically a rule that says companies have to share important information with everyone at the same time. They can't just tell their favorite investors first. To make it official, Discover and Capital One put out a press release, like a news announcement, saying that the shareholders had approved the deal. A copy of this press release is included as an exhibit, which is like an attachment to this filing. This is just a legal disclaimer saying that the information in this section is for informational purposes only and shouldn't be taken as investment advice. It also says that they're not responsible if someone uses this information and loses money. This is more of a legal thing that states information is furnished and not filed, so it isn't held to the same legal standards. This part warns everyone that they might make some forward-looking statements, which are like predictions about the future. They say that these predictions might not come true because there are risks and uncertainties involved. They list some of the things that could go wrong, like the deal falling apart, or regulators, which are government agencies that oversee businesses, putting restrictions on the merger. They also point out that you can find more information about the risks involved in their annual report, which is a more detailed document that they file with the SEC, the Securities and Exchange Commission. This just says that the exhibits or attachments to this filing include the joint press release and some technical data. This is a link to the joint press release, which you can read if you want more details about the merger approval. This is where a company official signs the document to make it official. Discover appears to be heading in a new direction as it merges with Capital One. Here's my take. Assessment of company direction. Discover has been a strong player in the credit card market, but merging with Capital One presents both opportunities and risks. The merger could lead to increased market share and cost savings, but it also faces regulatory hurdles and integration challenges. Notable risks or opportunities. One major risk is that regulators might not approve the deal or could impose strict conditions. On the other hand, if the merger goes smoothly, the combined company could become a major force in the financial industry. Stock price outlook. It's tough to put an exact price target on Discover right now because the merger is pending. However, based on current market conditions and the potential benefits of the merger, a reasonable price range would be $130, $150, assuming the deal closes. This assumes Capital One can successfully integrate Discover. Conclusion: I'm cautiously optimistic about Discover's future. The merger with Capital One could be a game changer, but there are still some uncertainties. I would lean bullish, meaning I think the stock price has more room to go up than down, but would advise investors to keep a close eye on regulatory developments. Thanks for watching. If you enjoyed, please subscribe, like, and comment.